Hi traders, welcome to another episode. So we were on this trade. We were anticipating that price would go to this fair value gap right here on our last trade on the last episode. So if you were with me on the last episode, you would have noticed that I highlighted this fair value gap right here, that price would have to tap into this fair value gap and give us a reaction. So this would be our reason for entry. Since price has given us a reaction and a break of market structure right here, let me show you. We have a reaction here. Price couldn't break past this fair value gap, so this reaction created for us a fair value gap. So this fair value gap, we were anticipating that price will tap into this fair value gap on Monday's opening by 6 a.m. So we're anticipating that price will tap into this fair value gap and give us a bearish move just like this. Put our stop loss above this high and our take profits at the fair value gap here. This whole candle is a fair value gap for the buyers. So this would have been our take profit here, and it should have given us a risk to reward of 2.86. And prior to that, there was a trade here. That was Sunday's midnight stroke Monday. There was a trade here. We have a fair value gap here. We call this part a demand area. This is a demand area here, and we would anticipate that price would cross above a previous high, just like so. You can see how price crossed above this previous high here on our 5-minute time frame and created a fair value gap here. So for personal reasons, I won't have taken this trade if I had seen it. So this was 1:30 a.m. So on Monday 1:30 a.m. So this would have given you a risk to reward of, so we would have put our stop loss here and our take profit would be at this high or this high here. This would have given you a risk to reward of 3.98 risk to reward ratio. So this was midnight and I wouldn't have taken this trade, and this one was before this trade that we were anticipating. So this showed us a bullish trade because price created a fair value gap right here. You can see a fair value gap here from this previous candle. Let me show you clearly. This previous candle's wick and this next candle's wick, in between you can see a fair value gap here, and we just highlight it and you see how price reacted from that fair value gap, created for us a fair value gap and a break of market structure right here. This is our break of market structure to the upside, indicating that price wants to move to the upside, and we have a fair value gap as I said earlier. So we have a fair value gap here. We are anticipating that price would tap into that fair value gap. No matter how many times price would tap into this fair value gap, it would give us a bullish move. So this would have been our entry on a long position. So our entry will be at that fair value gap and our stop loss will be at the low of that other block that created that fair value gap. So our take profit would be at this next high, this previous high here, or would have taken profits here at this start of this fair value gap here. That's where we would have taken our profits, if not at this previous high. So this would be a risk to reward of 2.6 risk to reward ratio, and this one was a failed trade because price did not rally to the upside. But if you had used this fair value gap down below here, you would have gotten in on that trade that we're anticipating last week. So we have gotten in on this trade for a 2.47 risk to reward ratio. So this would have been our first trade, but this was our first trade, and we skipped this because price did not hit our premium zone for a short position. So the next trade is our second trade, our number 2 trade. So we can see a fair value gap here, and you see how price reacted after touching this fair value gap. We wait for price reaction. So price did not give us a fair value gap here, did not give us a fair value gap here, but give us a fair value gap coupled with a break of market structure here. So remember, we have a standing fair value gap. You can see it to this extent. We draw it like this. Price is still dancing around this fair value gap here. So since we've spotted our next fair value gap and our break of market structure for our number 2 trade, this is our fair value gap here, this one here, see it here, the previous candles week and the next candles week. This in between is our fair value gap, so we draw it to the end like so. This would be our order block. You can see our price tapped into the order block past the fair value gap, but because of this advantage of having 2 PDRs, your fair value gap on your order block, then price respected those PDRs and rallied to the upside, and we have a fair value gap price was respecting initially. So we would have our long position like so, and our entry like that, and our stop loss right below this low that created that fair value gap, and would have entered here. Our take profit should be at this fair value gap here. Let me take that out. So this fair value gap would have been a reason for our take profits, because price might respect the fair value gap and bounce to the downside. Or if not, you can see how price rallied all the way to the next high, giving you a risk to reward of 6.97 risk to reward ratio. So let's put this like so, and price did not respect this fair value gap. You can see a push to the downside and a push to the upside, and created a fair value gap here that made price want to go bullish, exactly like that. And this was the reason why price could not respect any of this fair value gap to the downside. So our next trade is our number 3 trade. And you can see, let me put this by the side. This is a fair value gap here. This whole candle, you need to highlight the whole candle here. And since you can see a reaction, we would have to go back to this fair value gap to see if there is truly a fair value gap here. So we have a fair value gap, and that is the reason for this reaction. The next thing you would look for, as usual, is a break of market structure and a fair value gap. We have a break of market structure, price closed below this previous low, and the next one is our fair value gap. We have a fair value gap here. You just highlight the whole fair value gap like this and like this. The next thing is our entry. Since we have that in check, we have our position like this. So our number 3 trade goes like this. Our stop loss above this high that created a bearish fair value gap, and our take profit should be as this previous low. Or you have that fact that price might take out this whole liquidity like this. So you'd take your full profit here, so giving you a risk to reward of 5.39 risk to reward ratio, because price has taken this whole liquidity. So the next one is our number 4 trade. So let's move on. Our number 4 trade is like this, a bullish trade. So we have a fair value gap at first, like we always search for. You see how price reacted to this fair value gap. Price has reacted to this fair value gap. The next thing we look for is our break of market structure, which is here, and the fair value gap. We have a break of market structure. Price crossed above this previous high, and all you need is patience. You have to wait. Its price created an inducement, which is liquidity that price would have to take out before going to the upside. So we have break of market structure, first fair value gap and second fair value gap. Then we have inducement. So what are you waiting for? So we'd just highlight this fair value gap like so. And the next thing is put your long position here. You can put it here because we wouldn't want a bigger risk to reward ratio. So you have your stop loss here, and your take profit should be at the high. So we have a risk reward of 2.64 risk to reward ratio. And still you can use this previous high here, this one here, for your TP. That is your take profit, giving you a higher risk reward ratio of 2.97, almost a 3-point risk to reward ratio. The next one is our number 5 trade. You can see our number 5 trade is like so. We have like 2 trades in one, a trade and a re-entry. So we have a first fair value gap here. We have a first fair value gap here, and we highlight it all the way down here. You see how price tapped into it at first here. This serves as liquidity. Price takes out this liquidity, rally to the upside, and created a break of market structure because it's closed above this previous high and created a first fair value gap here. This is a fair value gap here, and you can see the next fair value gap also being respected here. So for our first entry, a long position from this fair value gap here, and our stop loss right below this low that created that fair value gap, and your take profits at this previous fair value gap, because this fair value gap is a fair value gap that could be respected. So you can take your profit there, and you can see that you have a 2.32 risk to reward ratio. Like I said here, we have a first entry, and this other entry is your next entry. That's your second entry. This is the fair value gap respected, and another fair value gap respected here, because this market has crossed above this previous high. This is a break of market structure. We have a break of market structure here, and we have an entry because of this fair value gap here. So this should have been your second entry for number 5 trade, and taking your profits here. So this is 2.7 risk to reward ratio. All right, so that is that. And the next one is our number 6 trade. Now you can see a fair value gap here, see a fair value gap, price respected here. The next thing we would look for is a bearish order flow, meaning that you want price to go down, giving you a break of market structure. Now we have a break of market structure here. Price went down and closed below this previous low here. After tapping this previous fair value gap, we would expect price to rally to the upside and tap this fair value gap here. So you can see how price tapped this fair value gap for our number 6 entry, and we have a short position here. So this is our entry, and this will be our stop loss at the previous high that created that fair value gap. You see our entry, and boom, we have a take profit here. You can take your profits here because this is your immediate low right here, and you can also take your profits here down below. Here you can take your profits at this down, because we have a fair value gap and a breaker here. So this is a very strong zone to not mess with. So we have a 3.8 risk to reward ratio right here once you tap into this, and you just highlight this fair value gap right here, highlight it to where market is, and we would anticipate a reaction. So but before then, we have our number 7 trade. So let's take this one out to see our number 7 trade. So our number 7 trade goes like this. We have a first fair value gap, we have a fair value gap here, and would anticipate that price would give you a break of market structure. We do not have a break of market structure here, so we want an obvious break of market structure like this. So we have a break of market structure, and we do not expect price to tap into this already mitigated fair value gap. The next thing we'll do is highlight this fair value gap on our number 7 trade. See how it's been highlighted, and we want a good entry. So we just highlight that one, and we have a short position here. We have at first our inducements here. You see our price rally to the upside and comes down. That is our first inducement. So we use that as a starting point for our entry. We expect price to tap into this area and eating out this inducement, which is our liquidity at first. So we'll take this and put our stop loss right at the high that created this fair value gap. Our entry is like so, and the next one is our TP. Our take profit should be at that immediate low, which is giving you a 1.84 risk reward ratio, or the next take profit giving you a 3.49 risk reward ratio, because this is a fair value gap and a breaker that can break your setup. So the next one is our number 8 trade. So let's take this one to this side, and you have our number 8 trade. See, we have this on our number 7 trade. This is our first fair value gap. So everything is like in sync, as one is going, then the other one is being open, like another setup is being formed, because once you are on a particular order flow, you just keep going on that order flow, because price might still respect the fact that it's going bearish or it's going bullish. So we keep on searching for more bearish setup since we are on a bearish order flow. Since you have a bearish order flow, you can see how price has created for us another fair value gap, which we can still use, and price taps into this fair value gap here, this fair value gap here, and goes down to create a break of market structure here. After price created this break of market structure here, we would anticipate a fair value gap for our entry. So we have a fair value gap here. It's being created, and we will just wait for a move to the downside. So we have a short position here, which we have been anticipating, and our stop loss should be right above that high that created the fair value gap, and our take profit is at that same fair value gap here. So we have that same fair value gap here for our take profit. So we can see it as so, giving us a 2.27 risk to reward ratio. So let's take this for our number 8 trade, and you can see a re-entry here. That's our number 8 trade, but you can see a re-entry here. Price had also created a fair value gap here again, so this you can enter here, giving you a short position like so, and your stop loss should be right above that high, that entry for that previous trade. Let me take this one out. You have this like this, and your take profit should be at that same fair value gap. So this would be a 2.3 risk reward ratio for a bearish trade. So that was our number 8 trade. So our next trade is our number 9 trade, and that same fair value gap we are using for our take profits. We are going to see how markets reacted to that area, giving you a bullish move to the upside, crossing above this previous high, meaning that it has created a break of market structure and a fair value gap. So we have a break of market structure and we have a fair value gap right here. This our fair value gap is our reason for entry, since we have checked this one first fair value gap here. The next one is our break of market structure, and the entry is our next fair value gap. So we have a long position like so, and our stop loss is here. Our stop loss should be at this previous low here. Our entry is this fair value gap, and our take profits should be at this fair value gap here. But if you want a higher risk reward ratio, because coupled with the fact that we have a previous fair value gap price was respecting, we can also increase our take profit to this spot here, this high, like so. So this would have given you a risk reward of 3.98, about 4 risk to reward ratio for our number 9 trade. So we have our next trade, which is our number 10 trade. Our number 10 trade is like so. On our 5-minute time frame, we'd see a fair value gap here, as you can see here. This previous candle and this next candle, in between we have a fair value gap, and we drag it all the way down to our order block here, and you can see our price tapped into it, went down, tap into it, goes back up, and we have a fair value gap here. You can see the whole fair value gap here and order block. So with speed, that price would go down to tap into this order block that has a fair value gap, giving you a bullish position. So we have a stop loss here, your entry, and your take profit here. your take profit here. So this will give you a 2.44 risk to reward ratio. For a higher risk to reward, you can also take your profit here, because price has crossed past this fair value gap. So this would give you a risk to reward of 4.56 for our number 10 trade. So the next trade we'll be looking at is our number 11 trade. So this is our number 11 trade. As usual, we have on our 5-minute time frame still on Thursday, we have a fair value gap here. See this fair value gap here. Price tap into this fair value gap, cross down below this previous low, giving you a break of market structure here. So we have a break of market structure. We have price tapping into this fair value gap prior to that, and the next one is a fair value gap. Price has created a fair value gap for that supply area, and we'll just wait for that same price to give you a short position around here. So you just enter at this spot, put your stop loss here, let your stop loss breathe. You can see how price almost taking us out. You can see how price has almost taken us out here, and our take profit should be at this low here. You can see this low. This is where you would have taken your profit, giving you a risk to reward of 1.76. For a risk reward that is higher, for a higher risk to reward ratio, using just the order block here, we would have gotten a risk to reward of 4.59 using this order block here. But using just this fair value gap, we'd have gotten a risk reward of like 1.92, or about 2 risk reward ratio. And you can see how price rallied to the downside and goes beyond to tap into a previously formed fair value gap, giving that same trade a 5.2 risk reward ratio. So let's go back to see where price tapped. So this is a fair value gap price tapped into on Thursday, April 25th, Thursday, and price tapped into this fair value gap. After price tapped into this fair value gap, we can see how price rallied past this previous. So this is not our number 12 trade. This is our number 12 trade. But looking at this on a higher time frame, like the 15-minute time frame, there will be a fair value gap right here that will serve as your entry for this position here. Well, let's look at this first. This is our number 12 trade. We have a fair value gap here. See fair value gap, a gap that is actually obvious on our 5-minute time frame, and price tapped into this fair value gap, created what? A break of market structure here. Price closed above this spot here, not really, but yeah, at this spot here, and created a fair value gap for our entry. You can see how price created a fair value gap for our entry. So this would have been a bullish trade. So this would have been a bullish trade like this. Your stop loss right below the low that created that fair value gap, and your take profit should be at this fair value gap right here. This fair value gap here, giving you a risk reward of 2.4. This fair value gap. This is 2.4 risk reward ratio. Though for a higher risk reward ratio, we have markets going past this to a fair value gap here. can see our price rallied up to this spot here, giving you a risk to reward of 12.74 risk to reward ratio. So let's go back to this. We have here on our 15-minute time frame, you can see after price crossed past that previous 5 minutes high, you see a fair value gap here. This was the reason for price going to the upside. And you know, prior to that, we have price tapping into that previous fair value gap here. So this would have been a 15-minute. This would have been a 15-minute entry for a long position. Your stop loss should be at this low here, and your take profit should be at a fair value gap here. As you can see, there's a fair value gap here, and there's also a fair value gap here. So if you had stopped here for a fair value gap, you would have gotten a 4.22 risk to reward ratio. So we have been using 5-minute time frame. So let's go back to our 5-minute time frame, and you see a trade here. See how price tapped into this fair value gap here. After price tapping into the fair value gap, created a break of market structure here and a fair value gap here. So this fair value gap and this order block is where we'll be looking at. So let's just use the order block, and you see how price tapped into the order block that created a fair value gap, and we have a bullish trade to the upside using this our previous high for our take profits, this high right here. And you would have seen a trade of 2.55 risk to reward ratio. And the next trade we have on our list is going back to our 15-minute time frame. I think we would see this more clearly, but let's take this out first to see if we have a trade here. Okay, so I guess we do not have any trade here for Monday's opening, but we can just highlight this fair value gap here. We can highlight this fair value gap, expecting price to do something here. So we can highlight this fair value gap, and once we see a break of market structure and a fair value gap like this, let me show you guys. Like this, price tapping in after giving you a break of market structure, then there's a fair value gap here. It taps it and goes up, or just like this. Come here, you see a reaction and crosses this previous high, giving you a break of market structure and a fair value gap here. You use that fair value gap to go up. Now let's take it to the 15-minute time frame here. So on its 15-minute time frame, you can see how price would not just look like it's going to the upside again, but let's look at it from a bearish standpoint. So we have a bearish order flow here, and you see that we have previously, you see a fair value gap here, price respected, and we have a fair value gap here also. So the next thing we'll look for is a break of market structure. We have a break of market structure already here. There's no other break of market structure aside that, and we'll be looking for a bearish trade on our 15-minute time frame. So we'd expect that price would go like this, and bounce to the downside. That would have been our Monday's opening trade. So this is it, giving you a risk reward of 3.98. So let's look at what Monday has for us, and let's stick to any order flow from the higher time frame. As you can see, the higher time frame from 5 minutes is much weaker than the higher time frame from the 15 minutes. So let's go, guys, and let's keep on backtesting. Let's look at our charts, and we'll meet to backtest again on the next episode. Peace.